One of the things I find most intriguing about this industry is that often a table, a chart, or a statement is offered, and it's offered without context or nuance. And that means there is very little understanding about what is driving what the chart or table is actually showing. Hello everyone, I'm Christopher Tate. Welcome to the latest episode of 10 Minutes with Tate. And in this episode, I'm going to talk about the importance of context. Normally I talk about context as a function of when we make our trading decisions. What does the overall market look like in terms of the decision we are going to make? But here I want to take a step back and look at more of the structural issue. There are structural differences between markets that are important, and which if you do not understand, you're drawn to false conclusions about what is actually happening. So it's necessary to understand these foundational elements. Many people think that you can get by in trading and or investing just by having a superficial glance at the way things are happening, or superficial observations, and think that that observation actually has some degree of relevance to you or some degree of importance to other people. This is particularly true if you're giving advice. If you are giving advice that others are going to follow, it means that you need to understand what is happening in a much broader context. And for those of you who are not familiar with The Princess Bride, which is one of my favourite films, this is a quote from it, and I think it's particularly apt for what I'm about to talk about. Since I'm going to be talking about dividends, which seems like a boring topic for traders, but it is actually important because it comes to this notion of structural elements, and structural elements that have an impact upon our decision making. Quick refresher. Dividend yield equals dividend per share divided by price. So we can instantly see a relationship between dividend per share and price. This means that within the context of what I'm going to talk about, that we need to understand how changes in price and how changes in dividend affect the yield. In general terms, in very simple terms, if I were to summarise this table, the only way you get an increase in dividend yield in reality, in the majority of occasions, is if share price stays stagnant and dividend per share goes up, you get an increase in yield. Or your dividend per share stays the same and share price goes down. That's largely the sum of it. And that's an important consideration. Because what I want to talk about is this little chart, which is doing the rounds, as if there is some degree of moral panic about this decline in dividends. What we have here are three stocks and their historical dividend yields going back to 2007. We can see Wesfarmers, CBA, Telstra. And what you see is there an ebb and flow in dividend yields. They're not constant. They can't be constant because dividend yield is a function of price. But unfortunately, this chart is presented without any form of context. And the context in which this ebb and flow occurs is immensely important. You'll notice here that I've block highlighted the high of their dividends. For Wesfarmers, it was 13.3%, for CBA 11.05%, for Telstra 10.94%. The problem with presenting this is this number acts as an anchor for people, particularly without understanding when that occurred. So people will instantly look at this and say, well, the max dividend yield for Wesfarmers was 13.33%. The last dividend in the measured period was 2.26. It's collapsed completely. But we need to think about this and the historical point at which that 13.33% dividend yield occurred. Quick question, when do you think it occurred? It occurred during the GFC, when Wesfarmers had a 62% drawdown. So to achieve or to perceive that you're receiving a 13.33% dividend yield, you've lost more than half your investment. We're back to this notion that yield and share price are related, and we can't break that nexus. There's nothing we can do about that. That's just the way it is. It's the same for CBA. During that period, CBA had a 58% drawdown. Again, you'd lost half your investment, but you could console yourself that your dividend yield was going up. We need to add in a broader picture, and I'll actually come back to a variation of this at the end. And this is the long-term growth of these three stocks going back for this measured period. You can see that CBA is a 10-bagger. During that period, it is up 1,158%. And you can see the dips from the GFC and COVID. Strangely enough, if we were to superimpose this over the previous chart, what you would see is during those periods, the dividend yield lifted, or the perceived yield lifted. But you would have done half your money. So we have this trade-off. And the trade-off has always been, what do you want? Price return or dividend return? My argument is that there is no sensible reason for investing for dividend whatsoever. You invest for capital growth, and you continue to do that right up until you pop your clogs. But there was a series of additional charts posted in this particular piece that's going around. And this is the ASX 200, 12-monthly dividend yield. And we can see it ebbs and flows around a mean value. And again, if we look to the GFC, we can see yields go up. Again, price and yield are related. But we can see that it moves around a mean. It is not a static figure. And there does seem to be this misunderstanding in financial planners and the financial planning sort of arena. The dividends are static, that they stay the same all the time. They don't. The yield you receive is a function of the price at which you have invested in. If you're now investing in CBA, then your dividend yield is markedly reduced from if you had begun your investing career during the GFC. The other chart was presented, and this was presented as some sort of moral panic, without actually understanding what was occurring to drive the particular changes we see here. This is the average US dividend yield, and you can see that over the past 100 years, there's been a precipitous decline in yields in the US. There are reasons for that, and you can see at present that the average yield in the US is hovering around maybe the 1 and a bit percent. So from the perspective of an Australian investor, that's very poor, because if we flip back to our chart here, the average for us is about 4.5% in broad terms. So 1 and a bit seems really quite poor. So there's a cultural difference. And we can explore that cultural difference, and we can explore the impact of dividends on returns. This is the ASX 200, but all mapped against the ASX 200 total return. What the total return does is it folds back in dividends, and it folds them back in instantaneously and compounds them. So you can see a total return is, as you would expect with the level of our dividend returns, higher than price only. That's to be expected. And that has always been the way in Australia. And if I simply look at the contribution of dividends, we get this nice, lovely chart from about 2012, once we recovered from the GFC, once we recovered from COVID, and we just continue to trend up. We can do the same thing for the S&P 500, but here you see the differential is less than what we get here in Australia. And that is because the contribution of dividends is less and is lessening over time. But there are reasons for that. And this is just looking at dividends themselves. And it looks similar to the Australian return, but you'll notice the quanta, it's much less. It is reduced dramatically. And we can see this when we look at our dividends versus US. We have a final figure for us approaching $5. For the US, they're approaching $3 over this time period. So a substantial difference. And the difference is real. There is no bones about that at all. But the first question we need to answer is, what is the backdrop to all of this? Why does the US look different to us? And should we take the chart I posted earlier of the very, very long-term rate of dividend payments in the United States as A, a harbinger for us, and B, can you take it in isolation? Does it actually mean anything without context? When we look at the historical context of dividend yields in the US, we see something interesting. We have a timeline here, and the timeline is pre the 1950s. Dividend yields were very similar to ours, between 4 and 6% on average. Again, we're back to that somewhat rubbery expression, on average. And they're the primary method of shareholder returns, and we'll see that in a moment from the perspective of corporates as well. From the 50s to the 80s, this decline begins to accelerate. And it accelerates because there is a shift in philosophy, which I'll look at in a second. The 80s to 90s, sharp decline. The decline occurs because the buyback era has begun. Legislation has changed to facilitate buybacks en masse. From the 1990s to today, we've got this sort of equilibrium at 1 to 2% average yield. The world has changed, and there are reasons for that occurring. This does raise the question as to why do companies in the US like buybacks? Well, as I said, there was a rule change. SEC's rule 10B-18 has facilitated this and accelerated it. They give companies flexibility. If you pause a dividend as a company, it is somewhat of a black mark against your name. That doesn't occur with a buyback. It is a method of signalling. The management can say that we perceive that we are undervalued. The market has mispriced us. There is also a tax efficiency. And traditionally in the US, as we'll see in a sec, dividends were treated unfavourably by the IRS. Buybacks were treated more favourably, so there was this drift towards them. Over time, this has changed. There has been an alteration in the tax regime, and the tax rate for capital gains tax and the dividend tax rate have narrowed over time. But there is still this momentum now towards buybacks, and that momentum I don't think can be checked. It is now part of US corporate culture. There's also been a change in the way that valuation occurs in the US. If we look at this from the 1950s and 1970s, average PE 10 to 15. The average PE now is 15 to 25, and even higher when you look at technology stocks. And in part, it is the technology stocks that are driving this movement away from dividends themselves. But we have macroeconomic features as well. We had, up until recently, a period of declining interest rates, lower inflationary environment. Institutional investment has grown dramatically. So too has the interconnection of markets. So they've become more globalised. Instead of having segmentation across markets, we now have bleed across markets, and we'll see that part of this is bleeding into our market. But there's been a change in corporate culture. Pre-1980s, widows and orphans. Dividends were seen as the primary mechanism of return. This constant notion of steady payout was perceived to be corporate strength. And those who are income-oriented, like a lot of Australian investors are, expected regular payouts. There has also been an evolution in corporate culture. So we have this traditional perspective. And the traditional perspective was very much based around the idea of widows and orphan stocks. So dividends were their primary mechanism of return. And corporations saw themselves as the providers of this, and they believed that if this did not occur, that there was sort of a black mark against them. It was a sign of corporate strength to have regular payouts. And much like we have here in Australia, income-oriented investors expected a regular payout. There has been a shift, and we do have a evolved perspective. So dividend policy is less fundamental to value. Investors can manufacture income by selling shares. This notion of reinvestment is prioritised over distribution, especially in growth sectors. And this notion of growth sectors becomes important when we begin to look at the way the distribution of companies within the US has actually changed. Market composition has changed over time. In the 1950s, the market was dominated by what we'd call capital-intensive industries. Traditional firms, utilities, railroads, heavy industries, and these are dominated by high payout ratios. But the modern market is different because technology has changed, the world has changed, and markets have altered to reflect that change. The modern market is very much growth dominated. It is growth focused. That's the way it functions. This is in part why PEs have expanded, because valuation methods for these companies, or traditional valuation methods, don't really work all that well. And this is our typical software companies, platform, asset-light models, and they have low or no dividends. And so what we see is that dividend yield is diminished. That's simply a function of the way the world has changed. And I come back to this notion of you have to understand structural change. You can't just put up a chart and say, well, US dividends have collapsed, the world is going to end, we will never have dividends again. You have to understand why that has occurred and what it means, because once you understand what it means, you can move forward with some form of planning. There is a change too in preferences, where we've moved from this notion of reliable sort of mums and dads stocks that you would hold forever and they would pay you a dividend forever. We now have a proliferation of ETFs. We have stocks focused on price growth, and we have this notion of the buyback occurring. The conclusion is really quite simple. There's been structural change. This is not a temporary thing. This change has been coming for 100 years and has great momentum. So it is not a source of moral panic. It is simply a function of history. And history has its own momentum. And that history is powered by the notion of a variety of regulatory changes and global changes. This does raise the question for us. So will buybacks replace dividends on the ASX? And my quick answer to that is maybe. We do have somewhat of a buyback boom going on here in Australia. And buybacks are accelerating. So they are becoming a feature of the Australian market. And it is something we have to be aware of. And you can see quickly here that the numbers we're talking about are not small. As of the August 2025 reporting season, there is an estimated $5 billion in buybacks going on, and they're occurring across a raft of industries, but generally in the banking sector. So again, not a temporary phenomenon, not a small phenomenon, and they do have implications. And the implications for individual investors are that if you're a traditional mum and dad investor here in Australia, and your investment decisions have been driven by a thirst for yield, the first thing I would say is you've probably made an error. And this comes back to my earlier point that we invest for price. We invest for capital gain. You can always sell shares. There are mechanisms to generate income. There is also a wider issue with this. If you are a dividend-reliant investor, you're reliant upon somebody else. As a price-based investor, you're reliant upon yourself and your own decisions. Yes, I do understand that the majority of people would like to outsource their decision-making to others. The last thing people want to be is responsible. That's not really the default setting for most people. But there are some benefits to buybacks. They underpin the share price and they can boost long-term capital growth. And since we're looking for capital growth, this is what we want. So it is not a doom and gloom scenario. It is a scenario of adaptation and evolution because structural elements of markets change. But the final point I want to make is to return to a variation of slide on Commonwealth Bank. And this is the growth of Commonwealth Bank, $10,000 invested from that period that the original slide that I took a big stick to started with. Your $10,000 invested into CBA at the beginning of that period would now be $125,000, thereabouts, depending on the timing of when I snip this. I would much prefer that than a guaranteed 5% fully franked every year.